Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 29th of April. My name is Fook Hien and I'm your host for the podcast. President Trump has paused the implementation of specific tariffs on individual countries for 90 days or up until the 9th of July. This is giving some breathing room for investors to assess the outlook, although it is still very uncertain, which is why we have trimmed our view on global equities to neutral or a call holding now, as I explained in yesterday's podcast. We continue to see a lot of headlines on tariffs between the US and China, and for outsiders, it really isn't clear how much negotiation is really taking place at the moment. However, an interesting comment I thought from the Chinese Foreign Ministry was the confidence they expressed in reaching the 5% growth target for China this year. Now, before the US tariff announcements on the 2nd of April, China had already set their target for 2025 GDP growth at 5%. And to reiterate this target again now, after the tariff announcements, is a huge sign of confidence, I believe, especially when economists have been downgrading their GDP growth estimates since the tariff announcements. The consensus on Bloomberg for China's GDP growth this year is now 4.2%, which is lower than the estimate of 4.5% at the end of March before the tariff announcements. Now, if China is really serious about hitting the 5% target, this would imply even more stimulus from the government to reach the target. Indeed, if China can deliver GDP growth above consensus estimates, it is likely that Chinese equities would end the year higher. We do expect stimulus from the Chinese government to accelerate fiscal spending and ease bank reserve requirements to boost lending and revive domestic demand. We expect these policies to support consumption and investor sentiment. Valuation of Chinese equities is also attractive. 12-month forward price-earnings ratio of under 11 times is about a 38% discount to global equities. Historically, we observe the Chinese equities discount is around 30%. And besides policy stimulus, one big catalyst we see is the development of artificial intelligence tools or AI following the breakthrough from DeepSeek. The Chinese government is supportive of AI developments, which is likely to lead to wider adoption of AI tools, potentially improving productivity and the growth outlook for China equities. We believe this can support a higher valuation for Chinese equities. That is why we have an overweight view on China equities within the Asia ex-Japan region. Our view is that China equities is likely to outperform Asia ex-Japan equities over the next 6 to 12 months. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a great day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.